Welcome to Earnings Recap. Today, we're covering Starbucks Corporation's second quarter of fiscal year 2025 earnings report.
That's right. In this deep dive, we're looking at how Starbucks did financially for the quarter, ending March 30th, 2025.
We'll break down, the key numbers, sales, profitability, earnings per share.
And compare it all to last year.
Yeah.
And importantly, how does this all tie into their big back to Starbucks strategy?
Okay, let's jump right into those headline numbers then. For Q2, total net revenue came in at $8.8 billion.
Right, which is up 2% compared to the same time last year.
And if you strip out currency fluctuations, that growth was actually a little better, 3%.
Okay, 3% constant currency. But what about the bottom line, the profit per share?
Yeah, that's where the picture shifts quite a bit. GAAP earnings per share, that's the standard accounting measure, landed at 34 cents.
34 cents. And how does that compare?
That's a big drop, down 50%, half from last year.
Wow, 50%.
Half.
Okay. And the non-GAAP number?
Their non-GAAP EPS, which kind of smooths out certain items, was $0.41. Still a pretty steep decline, down 40% year over year.
Or 38% on that constant currency basis. So profit definitely took a hit.
No question. What else stood out on the sales front?
Well, a key metric is always those global comparable store sales in stores, open at least a year.
Right. How did they look?
They actually declined by 1% globally.
Down 1%. What drove that?
It was mainly driven by fewer people coming in. Transactions were down 2%.
Okay. Fewer visits.
Although the average amount people spent when they did visit, the average ticket, was up 1%.
So spending a bit more, but fewer transactions overall.
Exactly. And like you said, this is all happening while they're pushing this back to Starbucks strategy.
Yeah, the plan aimed at, getting things back on track. Management seems confident it's the right move, despite these numbers.
They're definitely sticking to the script on that. So let's dig deeper into that $8.8 billion revenue figure. Where did it come from?
Good question. How does it break down?
Well, that overall 2% increase, it was mostly pushed up by a 3.3% rise in revenue from their own stores, the company-operated ones.
Okay, the ones they run themselves.
Yeah. And there was a small 1% bump in other revenues. But revenue from their licensed stores actually went down.
Down? By how much?
Down 3.7%. So really the growth, such as it was, came from the stores Starbucks operates directly.
That makes sense. So how did things look regionally, North America, for instance?
North America saw just a slight increase, only 1%, bringing revenues to $6.5 billion.
Just 1%. What was behind that?
It was mainly because they opened more stores, about 5% net new company-operated store growth over the year.
So new stores helped. But what about existing stores?
That's the catch. Comparable store sales in North America were actually down 1%.
Down 1%. So similar to the global number.
Right. And if you look closer, transactions there fell 4%.
4% fewer visits. Ouch.
Yeah. Now, the average ticket did go up 3%, which offset some of that, but still fewer people coming through the door.
And licensed stores.
Their licensed store business in North America also declined. So, yeah, opening stores, but seeing less traffic in the established ones.
Fewer visits, even if they spend a bit more. Okay, what about internationally?
International looked a bit stronger on the top line. Net revenues were up 6%, reaching $1.9 billion.
6%? What fueled that?
Several things. They grew their company-operated store count by 8%. Their international licensed business also grew. Plus, they had that acquisition, 23.5 Degrees Topco Limited.
Right, the UK acquisition.
Exactly. But that growth was held back a bit by currency, a 2% negative impact from foreign exchange.
Okay, and comparable sales internationally.
Comps were up 2% internationally.
Okay, positive territory there.
Yes. But it's interesting how transactions were up 3%, but the average ticket actually decreased by 1%.
Huh. So more people, but spending less per visit.
Yeah.
The opposite of North America.
Pretty much. And within international, China is always key. How did China do?
China comparable store sales were flat. 0% change.
Flat. How did that break down?
Well, transactions were actually up 4% in China. Okay, more traffic.
The average ticket dropped by 4%, so they perfectly offset each other. Very different dynamics compared to the U.S.
That is a really interesting contrast. Okay, last piece of the revenue puzzle. Channel development. The grocery store stuff.
Right. Coffee sold outside their cafes. That segment saw a 2% decrease in net revenue, down to $409 million.
Down 2%. Why was that?
Mainly due to lower revenue from their Global Coffee Alliance.
Okay.
Although their global ready-to-drink coffee sales did see an increase, which helped a bit.
All right. So definitely a mixed picture on revenue depending on where you look. Let's pivot to profitability now. Those EPS numbers we started with suggested making money was tougher this quarter.
That's putting it mildly. Yeah, their operating margins, how much profit they make from core operations, they really contracted significantly.
How much are we talking?
The standard JAP operating margin fell from 12.8% last year all the way down to 6.9% this quarter.
Wow, almost halved. And non-GAAP.
Non-JAP margin also dropped substantially, from 12.8% down to 8.2%. Big drops across the board. They're keeping much less profit for every dollar of sales.
Okay, what were the main culprits for that margin squeeze?
Starbucks flagged a few key things. First, deleverage. Basically, costs grew faster than sales, which pressures profits.
Right, fixed costs spread over slightly higher, but not high enough sales.
Exactly. They also pointed to higher labor costs. This seems tied to investments for the Back to Starbucks Plan Think training, maybe boosting staffing or wages for store operations.
So investing in the turnaround makes sense.
And lastly, they mentioned restructuring costs. They're trying to simplify their global support organization, and that comes with costs.
Got it. So investments in the future strategy and some operational cleanup are definitely hitting the short-term profit numbers.
It certainly looks that way. Spending money now, hoping for gains later.
How did these margin pressures play out across the different segments? North America.
North America's operating margin took a really big hit. It fell to 11.6% from 18.0% last year.
18 down to 11.6? Ouch. Main reasons there.
Primarily that deleverage effect we discussed and those higher labor costs.
Okay. International.
International margins also dipped, going down to 11.6% from 13.3%.
Not quite as severe a drop as North America, but still down.
Right. And the drivers there were a bit different. Mainly increased promotional activity, like discounts and those restructuring costs we mentioned. Leverage from sales growth did offset some of it, though.
And channel development, the grocery segment.
That saw its margin decrease, too, down to 47.3% from a very high 51.7%.
Still very profitable, but less so.
Exactly. That was mostly due to higher product costs for the Global Coffee Alliance stuff and also less income from their North American Coffee Partnership joint venture.
Okay, so it really looks like those shrinking profit margins were felt pretty much everywhere in the business.
Yeah, quite widespread.
And as we said right at the start, that flows directly through to the earnings per share.
Precisely. Lower operating income, lower margins. That's the direct cause of those big year-over-year drops in both GAAP and non-GAAP EPS. Less profit overall means less profit per share. Simple as that.
Right. A tougher quarter for investors looking at per share earnings. Okay, moving beyond the main income statement lines, any other key financial details we should touch on?
Yeah, a couple of things. They kept expanding their footprint, opening 213 net new stores in the quarter.
Still opening stores? What's the total now?
Globally, they're at 40,789 stores. And it's interesting, the U.S. and China combined make up about 61% of that total portfolio.
Wow, heavily concentrated in those two markets.
Definitely. Also, those restructuring charges we mentioned, they booked $116.2 million in pre-tax charges related to simplifying their support structure.
So severance and related costs?
Seems like it, yeah. Primarily severance.
Okay. What about shareholder returns, dividends, buybacks?
They declared a cash dividend, $1.61 per share, payable at the end of May.
Okay, dividend is still there.
But what's noticeable is they didn't buy back any of their own stock in the first half of this fiscal year.
No share repurchases. That's different from last year, isn't it?
It is. They had significant buybacks in the same period last year. So a change in capital allocation there, at least for now.
Interesting. What about cash flow overall? First half of the year.
Generated $2.4 billion in cash from operations. That's down from $2.9 billion last year.
Down a bit. Why?
Partly the lower net income we've been talking about, and also looks like they built up some inventory.
Okay. And investing and financing cash flow.
They used $1.5 billion for investing. That includes the payment for that UK acquisition, 23.5 Degrees, and used $1.4 billion in financing, mostly for paying out those dividends.
Got it. And looking ahead, capital spending for the year.
They expect capital expenditures for the full fiscal year 2025 to be reasonably consistent with fiscal 2024. So similar levels of investment in stores and equipment.
Okay, thanks for that rundown. So let's try to bring this all together. Starbucks saw, well, a slight bump in overall revenue, mostly from their own stores and expanding internationally.
Right, but underneath that, North American traffic was down, even if spending per visit was up. China was flat overall, with more traffic but less spending per visit.
And the big story seems to be profitability. Took a major hit. Margins squeezed. leading to much lower earnings per share compared to last year.
Yeah, and that seems directly linked to a mix of factors deleverage, higher costs tied to the back to Starbucks investments, and those restructuring activities.
It really highlights that classic tension, doesn't it? Investing in a long-term strategy versus delivering strong short-term results.
Absolutely. You see the costs of the strategy hitting the bottom line right now. Management is playing the long game, expressing confidence, but the current numbers, well, they show that profitability declined quite clearly.
So, for you, the listener, the busy investor wanting the key points, this report really shows a company in transition. They're spending now, impacting current profits with the goal of improving the business for the future.
Yeah, and it really tees up a crucial question for anyone looking at Starbucks. How do you weigh these current investments and the promise of a turnaround against the, very real drop in profits right now?
They're clearly putting future goals first, accepting some short-term pain.
Exactly. So as you digest all this, maybe think about this. How will Starbucks' focus on driving more visits, getting those transaction numbers up, and streamlining how they operate, how will that ultimately impact their future results? And, maybe more importantly, how does that fit with your expectations for this turnaround story?
A great question to ponder. Thanks for diving deep with us on Starbucks' latest quarter.